The textile giant also plans to ramp up the production capacity, but going forward, will high raw material prices play spoil sport for the margins? Let's ask Kulin Lalbhai, Executive Director at Arvind, that precise question and more. Kulin, thanks so much for joining in. Let's start off with the overall numbers. They seem to be lower than estimates, Kulin. Did they measure up to your own expectations, or were you internally disappointed as well with the performance in Q1?
No, actually, we are very, very happy with the numbers. We are absolutely on budget. And in even subdued market conditions, our brands business, once you adjust for GST, has grown at close to 20%. So the GST adjustment is what makes the revenue seem lower. Even in our textile business, our garments, which is our growth driver, has scaled up very, very well. So I think it's a very strong quarter as far as we are concerned, both for revenue and on the EBITDA side as well.
The textile segment might have a lot of promise, Kulin, but grew only 2.3% in this quarter. Why has that been the case? What's the outlook?
Yes, I think in our textile business, we are very confident that for the year, we are going to achieve a 10% growth, which will be amongst the highest growth we will have in the textile segment. And since we are ramping up on our garment capacities, this will come over the next few quarters. It's going to be back-ended. So you will see the textile business post strong growth. And this was the current plan for Q1. So we have achieved the plan as far as Q1 is concerned.
Okay, what about the garments and the denim business? Because the denim business in particular looked very weak this quarter.
Yes, I think our denim business has seen a little bit of subdued demand in India since the GST went. We are seeing a recovery every quarter, but I would agree compared to last year's base, which was a pre-GST base where a lot of fabrics went into the market, you are seeing a negative volume on denim. That being said, with our garmenting capacity scaling up and our verticalization coming in, we are quite bullish even on our denim business, because we believe that the whole vertical strategy of selling garments is what will bring strong growth for us even in denim.
Okay, you started off the year with the guidance of a robust FY19. Q1 has been, well, in a manner of speaking, subdued. Would you believe that Q2, Q3, Q4, we will see strong delivery and will enable you to justify the bullishness of the street?
Yeah, I think in textiles, you will see two impacts. One, as I mentioned, our technical textile business along with our garments business. These two are going to be very strong growth drivers. And you will see the growth increase. So for the year, we have got strong growth targets for textiles that will come through. The second thing in our textile business is that the currency, which is now of course much better than it was a couple of quarters back, is not still visible in our numbers because we have a forward hedging policy. So as the quarters go on, our effective currency rate will reflect what the current currency rate is. And so you will see an improvement on the margin side as far as our fabric business is concerned as well.
Okay, what about margins? Currency tailwinds, raw material benefits, all of them working for you arguably. How does the picture look like for the rest of the year?
Yeah, I think in our textile business, our EBITDAs have been lower year on year clearly. Two impacts. One is last year we had a peak currency benefit because again, we had a forward hedge. This year we have the peak negative on currency, so you're seeing a big difference year on year. But our currency would keep improving every quarter because we do a continuous hedge strategy as far as our currency is concerned. So you will see realizations improve.
Interest costs and higher tax rates, will that impede the growth of PAT? Because this quarter, Kulin, we've certainly seen the below the operating line numbers having a bit of an impact on the bottom line.
We do believe interest costs are going to rise across the board in India as the rate cycle goes the other way. So we have budgeted for that. But I think net of all those impacts, we should see an improvement in the EBITDA trend as far as our core textile business is concerned as well.
Okay. Some color on the branded and the retail segment for the rest of the year?
So this was a very strong quarter for us as far as the brands business is concerned, even though it's been quite a subdued demand profile in the market. We have seen an industry leading growth adjusted for GST. Our growth is close to 20%. And that is, our power brands are growing very well. Unlimited, our value format is growing again at 20%. Our innerwear business is growing at more than 50%. So we have shown a strong growth in a tough market. I think it's a reflection of the strength of our brand portfolio and how unique the brand portfolio is. Also, we have shown a very strong EBITDA growth. So we have a 75% EBITDA growth in the brands business. And that is a function of our operating leverage kicking in. As we've been maintaining in this business, with revenue growth, there is a disproportional growth in the bottom line because the fixed costs in this business are in a way fixed. So as the brands mature and scale, a lot of the advantage comes to the bottom line. So we are seeing that impact, and we are cautiously optimistic for this strong trend to continue.
Okay. Lastly, the specialty store segment. Actually, a couple of questions, Kulin. First, the specialty store segment. How has that been for you? Because almost everybody believes that this has the potential to take your margins higher by at least 100 basis points for FY19.
No, we have always maintained the way we are growing in this business. 150 basis points improvement every year in bottom line is something which is definitely what the business can deliver. In this particular year, we want to really invest in future growth. So we are investing additional monies in marketing, almost 50 basis points more on a very large base, because we believe that the strength of the brands we have, there is a strong market share gain we would like to get in large segment, in many of the segments we operate in. So we are investing for future growth. So even this year, we've given a guidance of 100 basis points improvement in the bottom line.
Okay. Lastly, you have a clutch of other emerging businesses as well. There is Arvind Engineering, if I'm not wrong, specialty textiles. What about these emerging businesses? How have they done in the quarter? What promise for FY19?
I think one of our emerging businesses which has performed incredibly well is our technical textiles business. It's one of the key growth drivers which we have as far as our overall textile business is concerned. This year, in the first quarter itself, we have posted strong growth of 20% and of 10% and also strong bottom line. And we believe next year itself, this can be 1,000 crore business with a healthy bottom line. So I think the business is maturing. A lot of hard work has gone into creating the foundation over the last 4-5 years, and the business is coming of age. So some of the businesses like this, which we have incubated, are looking very exciting in the years to come.
Okay, Kulin, we'll leave it at that. Thanks so much for taking the time out and being with us today and giving us your thoughts.